We are almost at the end of Module 2. But before we wrap up, I want to introduce you to one or more key technical strategy: price action. Understanding price action is essential for reading market behavior and making informed trading decisions. In this session, we will cover two of the most powerful candlestick formations that can help you identify potential reversals and continuations: hammer and shooting star candles, bearish and bullish engulfing candles. These patterns are simple yet highly effective and can be used across all time frames to spot key market turning points. Let's dive in and break them down. Let's quickly cover the theory behind reversals candlestick pattern. These are powerful tools in technical analysis that signal potential trend changes in an asset's price. They help traders identify when an uptrend or downtrend is losing momentum, allowing them to anticipate market shifts before they fully develop. These patterns can be bullish, indicating a potential upward movement, or bearish, signaling a possible downtrend. Some of the most common reversals formations include the hammer, shooting star, and engulfing candle. While these patterns are useful on their own, they are most effective when combined with other technical indicators for confirmation and better entry timing. Now, let's take a closer look at each of these reversal patterns and how they can be applied in real market conditions. Let's start with a hammer candle, a price pattern that signals a potential reversal after a decline. A hammer candle forms when price drops significantly below the opening during the session. But buyers step in, absorb the selling pressure, and push the price back up, closing near or above the opening. Its key characteristics include forming after a downtrend, a small body showing minimal movement between open and close, and a long lower wick, at least twice the size of the body. The close can be slightly above or below the open, but the body must remain small. What does this candle tell us? The hammer reflects a battle between buyers and sellers. Initially, sellers drive prices significantly lower, but buyers regain control, forcing a strong reversal, almost entirely reversing the previous move to the downside. This shift in momentum suggests that buying pressure is increasing and selling pressure is weakening, signaling a potential trend change. Now that we have covered the hammer candle, let's move on to its bearish counterpart, the shooting star candle. The shooting star candle is the opposite of a hammer candle. It reveals a bearish price pattern that signals a potential market top and reversal. A shooting star forms when price initially surges well above the opening, showing strong buying activity. But by the end of the session, sellers take over, driving the price back down to close at or below the opening level. This shift in control signals a possible trend reversal. Its key characteristics include forming after an uptrend, a small real body near the bottom of the range, and a long upper wick, at least twice the size of the body. This long wick represents buyers who pushed prices higher but ended up in losing positions as sellers erased those gains. What does this mean? Early in this session, buyers were in control, but by the close, sellers had regained dominance, rejecting higher prices. This weakening momentum suggests a potential bearish reversal. Let's head to the charts to go over some real-life examples of both hammer and shooting star candles. Welcome traders to my practical application. Today we will talk about price action, how to trade shooting star candles and hammer candles. Let's go into the charts. Here, that's a Campus Fund trading platform. That's TradingView. We can analyze and execute all of our trades here. Okay, let's start to talk about hammer candles and shooting stars. What is the right position for hammer and shooting stars in a trend. Here, you can see it as an uptrend, right? And here it is a downtrend. Let's start with hammer candles. The right place for hammer candles are in lows or higher lows. It's here and here to trade the impulse. In downtrends, the right place are the lows and the lower lows to trade the correction, right? Correction, most of the time less profit margin, impulse trade, more profit margin. Next step is a shooting star. Where's the right place for the shooting star in an uptrend? It is high or higher high positions. Here you can see you will trade only the correction, not the impulse with a shooting star, right? Only from the high to the higher low or from the higher high to the higher low. Great. And for a downtrend, here, of course, it is the best of the best again. It is to trade the impulse, right? You can expect always a lower low. That's perfect. Great. Let's talk about the hammer candle in a real life example. Here it is a S&P 500 on a weekly time frame. And look at this. Here we have a picture perfect hammer candle. But what's about the trend? Let's start to identify the trend here. And I'll just use a line, okay? It means it's a low, it's a high, it's a higher low, another higher high, higher low, and a higher high. Yes, we are in an uptrend. And look, the position here of our hammer candle is in the higher low area. Remember on this example, we have the opportunity to trade the impulse, right, with a target above the previous higher high. Great. We have two opportunities to trade this hammer candle. Option number one is here on the higher time frame. We can go with the proximal and distal here, right? We have to place our lines on the high and on the low of our hammer candle. And option number one is long above, meaning we have to wait for the next candle, in this one the next week, right? And then if we cross a line, right, if we move higher above our hammer candle's high, then we are getting filled, long above. And the stop loss below the distal. Additional 33% is our recommendation always. Let me add the long tool. This is our long with entry opportunity 1, and the target here, of course, it makes sense to expect a lower low because it is an impulse trade. Risk to reward ratio is 1.24. How we can increase our risk to reward ratio? Zone refinement, okay? For that, we have to go into a lower time frame to identify, in this case, high quality demand, right? To decrease our zone size and increase our profit margin. Let's go to daily. And on daily, it looks already okay, right? There's a drop, base rally, but maybe on the next lower time frame, it looks more significant, right? Much better than the zone. And look, here, that is a picture perfect zone. It is a leg in candles, a huge drop, 3 indices of base candles, and then a rally. Perfect. This zone looks amazing, right? Let me this as well. Proximal and distal. I will change the colors very quick. Blue is always our lower time frame, and the gray or white box is our higher time frame zone. Look, we identified here the demand zone, and the demand zone is a part of our higher time frame hammer candle. And I think it's easy to see, right? Compare the zone size, please. Yes, you can see we can increase our profit margin a lot. Let me move the long tool here a little bit for option 1, and I will add a long position for option 2. That's here. Stop loss again below the higher time frame hammer candle low, okay, additional 33%. Entry is now here, and now compare it, right? Compare the entry with option 1 to the entry option 2. Completely different. Of course, the same target, right? Again, a new lower low. Okay. Option 1, risk to reward ratio 1.24. Not the best, right? What's about this? Here. Risk to reward ratio 4.81. Almost 5 Rs. We have also another opportunity. We can move our stop loss. Here we use the higher time frame hammer candle low, right? But we could also use just the distal of our lower time frame demand zone. Up to you. But of course, you will increase the probability to stop out, right? I would recommend definitely to go with this stop loss, as always. That's the best. You have a lot of protection, but still a nice risk to reward ratio. Okay, probability to getting filled here with the option 2, a little bit less, right? Compare it. Here's our entry. That's the current price. We have to go down, all the way down, and we have to hit the zone here and then a rally. Completely against the option 1. We just need a little bit more strength and then we're getting filled. Okay. Let's play this one out, okay? I'll press the play button and then let's wait. You can see option 1, we're getting filled, right? Immediately. Wow, and a lot of strengths and strengths and strengths. We can't see any pullback into our hammer candle, right? Into our lower time frame demand zone. Let's wait. We are close already to our target. More weakness, and I think I could stop it here already because we was close to our... Okay, let me stop this now. Look, with option number 1, right, the whole hammer candle on the higher time frame, we hit a new, or we got a new higher high, right? Full target, but a little bit less profit margin maybe, because it's just 1.24. But we're getting filled, or we got filled. With option 2, with a crazy profit margin, right? With almost 5 Rs, yes, nice profit margin, but end of the day, we never got filled. Okay, in this case, for the hammer candle in our uptrend to trade the impulse, the best decision was to go with the option number 1. Let's talk about another example. And here, a shooting star. This is Boeing, a stock. And you can see there is a nice shooting star, picture perfect. Also, the size of the shooting star is already small, right? Compare this with the previous example on the higher time frame. Okay, we identified the shooting star. That's fine. I can also highlight this one. Low and high. We will talk about the entry opportunities a little bit later. Let me change the colors. It's a higher time frame. White box. Great. Next step, direction, right? We have to check the trend. And for that, we have again to connect the pivots. Low, high, higher low, another higher high, higher low, and already a new higher high. And here it's a shooting star in an uptrend located in the higher high area. We can just trade the correction, meaning less profit margin, right? Different to the previous example, but it's definitely a valid trade. Why not? Okay, let's check this one. What is an entry opportunity 1? Short below. Let me add the short position tool here. And let me move the stop loss. That is again above the shooting star high. And here we need a target just for this example, okay? And I will go with this demand area here and the gap, okay? We will go with this one. This is our target. Short below, meaning we have to wait, right, that we close this candle and we will start with the next weak candle. And as soon as we get a drop below the shooting star low, we are getting filled, okay? It's the same like in the previous example with option number 1. Okay, here probability to getting filled, the best of the best, right? We need just a little bit weakness. Profit margin is okay, or not okay. In this case, I would say it's great. What is the reason for that? Look the zone size here of our shooting star compared with the hammer candle in the S&P 500 example, right? It was a huge zone or a huge hammer candle. This one is already small. And look, the risk to reward ratio, wow, 4.86 Rs. That's amazing, right? But here we could also go with a lower time frame entry. For that, first we have to change the time frame from weekly to daily. There is absolutely nothing, right? But we have more lower time frames. Let's go with the weekly. And here there's also nothing. But look at this. Maybe we get a drop-based drop. Let's wait. I will press a play button and then we can check. Maybe we'll create something, right? Okay, let me press a play button and okay, here we go. You can see we're filling more institutional unfilled selling orders. We're creating indecisive candles. That looks good. That looks really good. You can see that. We created here a rally base drop. Perfect. And this supply zone is a part of the higher time frame shooting star. We can go with that. Let me also highlight this one. And again, we will change the colors, blue and blue for lower time frame, right? White and gray box is a higher time frame shooting star on weekly. And the blue box is our lower time frame, in this case, 4 hours supply zone. Let me move the proximal line a little bit more accurate, like this. Okay, great. We can go with this as well. I will move this here and copy paste. Of course, we have now a new or a different entry, right? This one here is again our stop loss here above the higher time frame shooting star candle. And our entry, we moved our entry from the higher time frame to the lower time frame supply zone. It's this. And profit margin, it's the same again here. Okay, let's look at this. And now we increased our risk to reward ratio from 4.86 to 7.95, almost 8 Rs, crazy. But compare the probability to getting filled. By the way, we got already filled here, right? Now the question is, should we get more strength a little bit into our lower time frame zone or not? Let me press a play button and then we can see how this one plays out. Oh yes, look, we hit our zone again. You can see that here, and immediately crazy weakness. We filled a lot of institutional unfilled selling orders, and look at this, the result is a crazy drop. That's amazing. Don't forget, that was like an example. Wow, a gap down as well. It was an example, this target, right? But maybe we will hit this one. Let's wait. But here, right, we got filled with both entry opportunities. The first one immediately, right, with a little bit weakness. And then a couple of hours late, boom. Let me pause this one. And then a little bit later with a pullback into our zone here on the lower time frame, right? And also got filled. And crazy weakness. And again, into our higher time frame demand, right? Great. Risk to reward ratio, of course, this one here, the option number 2 was a better decision, right? If we talk about risk to reward ratio, but in general, we got filled with both opportunities. That depends on your trading style. Great. That was my practical application about price action. See you in the next one. Hammer and shooting star candles aren't the only reversal patterns to watch for. Engulfing candles are just as important and can be a powerful tool when combined with supply and demand or fundamental analysis. These patterns help identify market reversals as they happen, giving traders another way to confirm shifts in momentum and trend direction. Now, let's take a closer look at how engulfing candles work and why they are so effective. We will start with a bullish engulfing candle. The bullish engulfing candle is a strong two-candle reversal pattern that signals a potential shift from a downtrend to an uptrend. It forms when the second candle opens below the previous candle's low, closes above the previous candle's high, completely engulfing the entire range of the first candle, including its wicks. This pattern represents a clear shift in market momentum. In simple terms, bears were in control early on, driving prices lower, but by the end of the session, bulls took over with conviction, pushing prices sharply higher. When analyzing a bullish engulfing pattern, context is key. The first candle reflects selling pressure, while the second candle demonstrates a complete reversal, signaling a surge in buying strength. This makes a bullish engulfing pattern a powerful tool for identifying potential trend reversals, especially when it forms at strong demand zones. Now, let's talk about the bearish engulfing candle, a key reversal pattern that signals potential downward momentum. This pattern forms when the second candle opens higher than the previous candle's high, closes lower than the previous candle's low, completely engulfing the range of the first candle, including its wicks. A bearish engulfing candle highlights a clear shift in control. Bulls start strong, driving the price higher early in the session. By the end, sellers take over decisively, pushing the price down and closing lower than the previous low. This pattern often appears after an uptrend and suggests that bearish momentum is building, potentially marking the start of a downtrend. Now, let's bring everything together and explore how to apply engulfing candles in real market scenarios. Welcome traders to my practical application. Today we will talk about price action, bearish and bullish engulfing candles. Let's go into the charts, and here is our Campus Fund trading platform. We can analyze and execute all of our trades here. Let's go into the charts. Okay, here's a nice example of the euro US dollar on the daily time frame. You can see can identify this one as a bearish engulfing. You can see this candle engulfed fully the previous candle. Look, the high of our red candle is higher than the previous high, and the close of our red engulfing candle is lower than the previous low. Great, that is a picture perfect bearish engulfing. Let me highlight this for us. The low all the way up to the high. This is our bearish engulfing candle. That's great. So we have also to talk about the right position, right? About the bearish engulfing. And here, let's go with the direction. I will connect the pivots here for you. High, low, a lower high, a lower low, another lower high, lower low, and here this one is the lower high area. Perfect. This position is amazing, the best of the best. The reason is we have a downtrend and a bearish engulfing, meaning we have here the opportunity to trade the impulse. The impulse, always a better profit margin than a correction trade, right? Great. We could expect a target right here. below the previous lower low, meaning a new lower low. Let's add the short position tool. Okay, our entry. We have to wait for the next candle. Okay, here it's a daily time frame, meaning for the next day. And whenever we trade below the low of our engulfing candle, we are getting filled. That is our entry. Stop loss above the daily bearish engulfing candles high. Okay, additional 33% on top. Okay, target. We talked about it. We could riding the wave. We could expect in a downtrend a new lower low. But make it sense here. Let's check this. If we talk about supply and demand, you can see there is a demand formation, a demand zone. It's a leg in, a rally, two indecisive candles, and then a nice, powerful leg out, right? For me, to be honest, and you guys are already advanced, right? It makes no sense to expect a new lower low. We have high quality daily demand here. I would move my target all the way up to the preferred version here. And now let's check the profit margin. So bad, right? Less than 0.3 Rs. Makes absolutely no sense to trade this bearish engulfing with this risk to reward ratio. Probability to getting filled, of course, like always, that's the best. I love the option number 1 for the probability to getting filled. We have just to wait for the next day and trade below the bearish engulfing candles low. I think our job here is to increase our profit margin, right? And for that, we could go into lower time frames, looking for high quality supply and into this bearish engulfing candle. Let's go into the weekly time frame. And there is not really quality. Let's go to the daily. And look at this. I can see there are two zones, right? There are two zones. This one here, that's a drop-based drop. That looks good. And level on top of level. Look, we have a little bit more here above. You can see that, right? Okay. Meaning we identified a high quality or two supply zones. If we follow the level on top of level rule, we will go with this one here, right? We identified a nice high quality zone on the lower time frame, and it is a part of the higher time frame, in this case daily bearish engulfing candle. Okay, let me highlight this one as well. And here in this case, we will go with a wider version. It's a level on top of level. I'll change the colors. Blue boxes represents our lower time frame levels. White or gray boxes represents our higher time frame zones. Okay, look, it looks like this. And let me change or let me add our shorting tool as well. Okay, you can see that's option number 1. We talked already about it. And the idea for the lower time frame was to increase our profit margin, short position. Now our entry is here and our stop loss right above the higher time frame bearish engulfing high. Additional 33% for our stop loss. Okay, we can go with that. And now let me move our target to the right place. Now we have almost 1.8 Rs. It's so much better compared 0.3 to 1.8. It's definitely better, right? We could also go with a more aggressive version of our stop loss. Remember on the shooting star and hammer candle, we could also move our stop loss just above the lower time frame supply zone. Here, yes, probability to getting filled, it's the same, risk to reward ratio. Of course, we increase it. The reason is that we reduced our zone, right? But we increased also the probability to stop out. That's up to you. It's never right or wrong here. That's up to you. Depends on your trading style. I would recommend always to move your stop loss above the higher time frame bearish engulfing candle for better protection. Okay, let's press the play button and then we can see what will happen. We have to wait, right? Option number 1, option number 2. Oh, look, we hit. Let me pause this one. And before we getting filled with option number 1, right, we hit our lower time frame down. Perfect. Now we are waiting for more selling pressure to fill more and more. Oh, we tested the zone again. We're filling more and more institutional unfilled selling orders 3 times. And now we filled enough institutional selling orders to get this drop. I will pause this one. That's great. And look, by the way, we identified this as our target. It was our higher time frame demand. And look, we hit our target here, our higher time frame demand zone, and then we got a reaction of it. It made absolutely sense, right, to move our target to this area here. You can see got filled with both opportunities, both entry options, right? But to increase your profit margin, option number 2 was definitely the best decision here. Okay, the next example is a bullish engulfing. And this here, the US dollar, Canadian dollar on the daily time frame again. And look at this. Here we fully engulfed the previous candle. The low, right? Check the green candle. The low is lower than the previous low, and the close of our green candle, our engulfing candle, is higher than the previous candle high. Perfect. Picture perfect bullish engulfing. Let me add our proximal and distal line. I will change the colors again. Blue for lower time frame and white or gray for the higher time frame. We are here in daily. This is our higher time frame. Okay, great. We identified now our bullish engulfing. Next step, the direction. This one is a high, a low, lower high, not really a lower low, lower high, lower low, lower high, and a new lower low. Look, this bullish engulfing is located in the lower low area of a downtrend. Okay, we never violated the lower highs. The bullish engulfing candle is located in the lower low, meaning it's a correction trade with less profit margin. Remember the example before, it was an impulse trade. Okay, unfortunately, it was impossible to trade the direction because we had demand there, remember. But here, this one is definitely a correction trade with, unfortunately, less profit margin. Okay, let's talk about the entry. I'll go with the long position tool, and here it's the same. Go this and this. We have to wait for the next candle. In this case, the next day. It's a daily time frame. Okay, and whenever we trade above the bullish engulfing high, we're getting filled. Stop loss below the bullish engulfing low. Okay, additional 33% for your stop loss. Target, again, it is only a correction trade. It makes no sense to expect a higher high, right? Or anything above this one. Makes no sense. What makes sense is to check or to looking for supply. And look at this. Here is supply. And we have, again, the same issue. We have absolutely less profit margin. Just, again, 0.3 Rs. That's not enough, right? What could we do here? Lower time frame. We have to check here the lower time frame areas and look at this. Here is a rally base Really, the layout is amazing, right? Let me identify, or let me highlight this one. It's like this and this. I will change the colors. Blue. Okay, this one is now our lower time frame demand zone. But guys, make it sense, right, to trade a zone, a level like this. Remember always on the probability to getting filled, the risk to reward ratio. I mean, the risk to reward ratio. Let me add another tool. Move this here for option 1, copy paste. All the way down. And let's move the target as well to the same position. You can see we increased our profit margin now to 5.2. That's a lot. That's a crazy trade, right? Especially for a correction trade. But make this zone size here really sense. I would personally, right, I would increase my probability to getting filled. Meaning I would go here with a wider version. But again, that's up to you. Depends on your trading style, okay? I will move this here a little bit higher. And you can see I have still a nice risk to reward ratio, more than 3.5 hours. That's great. You'll check in a minute how this one works out, but we could also, I forgot to talk about the stop loss here. Of course, we have another stop loss opportunity for the lower time frame. Yes, we could also go with the stop loss below the distal, additionally 33%. But again, like always, I would not recommend this. Let's go with the stop loss here, right, with a coverage of the higher time frame daily bullish engulfing low. That makes more sense to decrease the probability to stop out. Okay, this one here is now our both trades. Probability to getting filled, the best of the best with option 1, risk to reward ratio, really, really bad. Option 2, probability to getting filled, not the best. I would say moderate. We go also with a wider version, not the preferred version. That's fine. Risk to reward ratio, excellent. Love it. Okay, let's press the play button, and oh, it's going crazy. And first, yes, we got filled with option 1. And then immediately we got a pullback all the way down into our lower time frame demand zone. Okay, we filled here more institutional unfilled buying orders. And then look at this. We got a nice rally. Let's press the play button. And don't forget, this one is a correction trade. And here we pause this one. You can see we hit our target here already. Okay, we got more and more strengths, but to be honest, we talked about the target. It's a correction trade. There was high quality supply. Makes sense here. You can see we got also a reaction here already close to our target, right? For this example, what was the best decision here? Option 1 or 2? If we talk about risk to reward ratio, definitely this one. It works out really, really nicely. Probability to getting filled, we got filled with both, right? Here again, it is up to you how to trade bullish or bearish engulfing candles. Great. Thank you for watching the bearish and bullish engulfing practical application with me. See you in the next one. This brings us to the end of module 2 now. Before I hand over to Clemens, I would like to give you a summary of all that we have learned in one practical application and put it all together. Here, I will cover our 3-step mechanical process, which includes location, direction, and lower time frame zoning process. Okay, so let's head to the charts. Welcome traders to my practical application. Today, I will talk about putting everything together what we learned before. We are using our Campus Fund trading platform. It's TradingView, by the way. We can analyze and execute all of our trades. I prepared an example already. Here, it's a Euro Swiss franc on the weekly time frame. Okay, step number 1, location. Step number 2, direction. Step number 3, zone refinement on the lower time frame. And then we will talk about the entry opportunities. Here we choose, or I choose, the weekly time frame. Okay, that's our time frame for location and direction. So meaning we will talk about the weekly income. Okay, location. We will start from the current price, and then we are looking for supply. We're looking to the upside and to the left without cutting any candles. And we are looking for explosive candles, decisive candles, any leg out candles. And let's start together. Look, the first candle is an explosive candle, a leg out. The other one is also a leg out candle. And another leg out candle, right? A huge drop here. This one is a green candle, decisive, and an explosive leg in candle. Okay, that looks like a rally based drop. The only thing what we're missing here is an indecisive base candle, right? Please check this candle here between the leg in and the leg out. But we have an additional rule for that. Everything what looks like a level is a level. And this looks definitely like a level, a rally based drop. Only without the indecisive base candle. But we can go with that. Let me highlight this. The proximal line on the lowest body of the base, and I'll change the settings here, sorry. And here the distal line, guys, it's a rally base drop, inverted U shape, okay? We have to put our distal line at the top of the entire formation. Great. Look at this. This one is our supply zone. Yes, everything what looks like a level is a level supply zone. Okay, back to the current price. The next step is you have to looking for the demand zone. Let's go to the downside and to the left. We're looking for leg out candles, explosive candles. Here, this one is already explosive. And then to the left, an indecisive candle, right? Picture perfect. And the leg in candle, it's amazing. That's our drop base rally, a U shape. Great. Let me add here also the proximal line and the distal line. Great. We are done to identify both zones, supply and here demand. Now we have to divide the range here between distal to the other distal. Let me add the Fibonacci tool. Just have to change the settings. 33, 66. I will add this here and here from distal to distal. And then we can see, right, where's current price located. Current price is located in equilibrium, unfortunately, not in the extremes, right? But we have more rules. We'll talk about this in the direction step. Before we start with the direction, I would like to talk about this here. This is a wick over wick. You learned everything. You learned already everything about the wick over wick in the blueprint. Let me highlight this, okay? The wick and the wick. Change the colors. Okay, that's our wick over wick. Most of the time, or not most of the time, always, right? It is a supply or demand zone on the lower time frame. Here, of course, supply. We'll talk about this in the last step, third step, zone refinement. Okay, great. We are done with the location. Current price is located in equilibrium. Remember, price located in the extremes, the high or very high means expensive or very expensive and expensive area. We are looking for a short opportunity. Equilibrium, we can follow the trend, right? That's also fine. And here, that is a cheap or very cheap, low or very low area. We are looking for a buying opportunity. Great. We will talk about the direction now. Let me zoom out. And the next step is to identify 6 pivots in total, 3 highs and 3 lows. A little bit zoom out, nice. Okay. From the right to the left, that is our first low, our second low, and our third low. Great. And now we have to identify from the right to the left the highs. This one is a high, another high, and another high. Look, now we have 6 pivots, right? 3 highs, 3 lows. I will connect the pivots here for you. That is a low. This one is a high. This is a lower low, lower high, and another lower low. And guys, a new lower high. Yes, it is a downtrend, right? It is a downtrend that is great. That's so much helpful for our location, by the way. The reason is we are located in equilibrium, and yes, we can follow the trend, right? We could, with the information of the higher time frame direction, yes, we can also looking for short opportunities in equilibrium. That's great. Here, and we are expecting, if we talk about direction, we are definitely expecting a new lower low, right? A new lower low, lower than the previous lower low. Okay, we are done with location. We are done with direction. Now we have to talk about the zone refinement on the lower time frame. I prepared already a checklist for us with all of our zone qualifiers. I will change the time frame, okay, from weekly to the next lower time frame. This one is our daily time frame. Okay, let me move this to the price, and here we can now discuss every single step. Remember, current price is located in equilibrium. Yes, it is allowed to short this one. We follow the trend, okay? Here, the first supply zone is this one. Look, a drop, base drop. And yes, it represents also week over week on the higher time frame. Let me change the lines here. Let me add more lines here for the zone on the lower time frame. Always for the lower time frame, I'm using the blue boxes, okay? And look at this. The blue box represents our higher time frame week over week here on the lower time frame. Great. This is our first supply zone, right? The idea is to short from this zone all the way down or to the opposing level. That's up to you. We will talk about this also in the entry opportunities and targets. Okay. Departure from this zone. You can see the leg out candle is explosive, right? That's perfect. We exactly need this. We can check all the other candles, more and more weakness. That's great. The departure is really good. Freshness. We have to check the freshness, yes, on the wider version, right? But here, not necessary. Please look to the right. You can see that we never tested our zone, right? Not on wider and of course not on the preferred version. Never, never, never. That's great. Originality. Is this one original or not? It is a drop base drop, okay? And yes, possible that this one is original or not. We have to look to the left. Is that a zone? And look at this, there is a zone, right? But it's a good zone. It was a demand zone. Meaning here, this week over week on the higher time frame, here, drop base drop on the lower time frame represents a flip zone. Really powerful zones. Perfect, perfect, perfect. This is a flip zone. That's great. Next is base duration. Base duration, here we have to check the indecisive candles between the leg in and the leg out. We have only 2. That's great. 1 to 3 basing candles are great. 3 to 6 acceptable, and more than 6 are not acceptable. Here only 2. Great. Profit margin. Let's check the profit margin together, and I will add again the Fibonacci tool. I just have to change the settings. I will add 4 hours to move this. Upsala. Okay, from here to this one here, right? And look, from our proximal line all the way down, right, to the turning point. This one is the turning point. You can see, right, we are starting to rally. And see, there's a 1, 2, 3, 4 Rs. That is amazing. Nice profit margin. At the moment, this level is really, really good to short, right? Next zone qualifier is our level on top of level. We have to check, is there a level above or not? For that, we have to copy paste the range of this one, and you can see, yes, this one is a part of a level on top of level. Okay, that's important that we understand, right, where this wick over wick or the drop-based drop is located. There is another level above. If we follow the rules, right, yes, we can trade only the level above or also the level below. We will talk about this at the last step, okay, our entry opportunities. Here, it is important to understand that this one is a part of a level on top of level. Great. Arrival. We have to wait for the arrival. Look, current price is located here. We have to wait, right? That price moves higher, more close to the level here, and then we can discuss our zone qualifier arrival. Let me talk about the entry opportunities. Okay, we'll talk about the stop, entry, target, set. In this case, we have a level on top of level. I will explain you the first entry opportunity. The first one is to combine both levels. Okay, the first and the second one. That's here. Preferred to the distal. This one is our entry. Okay, the preferred version of our first level, and our stop loss is above our distal for a level above, plus 33%. That's our recommendation. Where's our target? Here we could, of course, talk about the opposing zone, right? The demand zone. This could be our target. Or remember, on the second step is a direction analysis. We can trade the trend. We can follow the trend, meaning a new lower low. Means our profit margin is all the way down. Okay, great. This is our entry opportunity one. We combined both levels. Copy paste for the second one. We zoom in. And the second one is very easy. We have to split our position size to one or to two single positions. Okay, 50% and 50%. The first 50%, right, it's the same like entry opportunity one. We combine both zones. That's our first 50%. The other 50%, we'll not move the distal line, but we'll move our entry, okay, and all the way up to the wider version of our second level on top of level zone. Okay, of course, the same profit margin. Great. Here, the first 50%, and here, the other 50%. Copy paste for the third entry opportunity. That's here. And third opportunity is only, right, we will skip the first level, full position size on the level above. Here on the wider version, of course. So let's talk about the probability to getting filled and risk to reward ratio. That's completely different here with all of these entry opportunities. Look, entry opportunity one, we combine both levels. Probability to getting filled, the best, right? The entry that's here, it's close to the current price. Profit margin, risk to reward ratio 3.17. I mean, that's okay, that's good, right? But compared to the other one, let's go to the second entry opportunity, both levels here. The first 50%, probability to getting filled, amazing. It's the same entry, right? Like the entry opportunity one. The other 50%, look all the way up. Here's our entry now located. Probability to getting filled, definitely less, right? Profit margin, look, it's 12.53. That's amazing, but only with 50%. And here, 3.17 with 50% of your initial position size. Entry opportunity 3, that's only this one with the full position size, right? And that is 13.55 risk to reward ratio. That's amazing. That's a great trade. But probability to getting filled, definitely less. Look, the entry is here all the way up, really far from the current price. Okay, great. Let me press the play button, and then we will see how this plays out. Okay, press the play button and let's wait. And I can stop here already because we can talk about the arrival zone qualifier. Look, the arrival is really powerful, right? Look, all the green candles, just one red candle, for example, that's really nice. Arrival, also tick in a box. That's amazing. Okay, let's press the play button. And now, look, we hit our first zone here, right? With the entry opportunity 1 and the first 50% of the opportunity 2. Let's play this out. And we got already weakness. Amazing. I can stop this one. Okay, you can see this is what happened. Okay, this one is what happened. First, yes, we never getting filled with the second position size of the entry opportunity 2 and never with the full position size of entry opportunity 3. Only the first 50% of option 2 and the full position size of option 1. Okay, it's a reason why I talked a lot about probability to getting filled and risk to reward ratio. Here it's a nice example. Okay, and then we got a lot of weakness, right? A nice drop all the way down, yes, to a new lower low. That was the reason why we talked about direction, to understand the trend. The trend is here definitely our friend. And you can see it made definitely more sense to short, right, with the power of the direction, right, with the downtrend. Here, this one represents also our higher time frame demand zone. And look what happened. It was just a reaction, right? It was just a reaction, and then we violated the demand zone on the higher time frame. Here, it's a nice example that if you follow the trend, it's definitely better. Here you can trade the impulse. The long here from the higher time frame demand was just the correction. Great. That was my practical application about putting everything together. Thank you for watching.